explain the concept of inducement and engineered liquidity. So I will use the diagram to explain both of them. Then I will show them to you in this live chat for more proper understanding. Now, like this is the first leg. I will use an uptrend to explain it. First leg, second leg. This is the third leg. See something like this. Then see something like this. Yeah, when you have situations like this in the chart, many traders always identify this as a change of character, but I will still explain what you should do so that you will not fall into this trap. Now, this movement here is an inducement. Now, things you should know about inducements. Inducements are the first fake out on a trend or on a pair that induce people into the market to enter a buy. You understand? That is an inducement, and the things you have to understand inducement in the chart is inducement always reacts from a fair value gap above an order block. That is an inducement. So now, being that said, there is a break of structure. Inducements always take out the high. If you take out the high, they either react from the opposing fair value gap to come back and react from them what's it called, order block before taking out the other high. Now, when you see situations like this, I always call it a plus a top, because I don't always enter the market with this first leg. When I see this initial movement here, I don't always enter the market here. I always wait for this, because this movement, if the market have not indicated the other block, I always go and wait for the other block, because that area shows that it's a plus a top. So this is for inducement. Let me explain the other one. Engineered liquidity. So this is the concept of engineered liquidity. You see a movement like this in the chart. This is engineered liquidity. You get? Now, similar with inducement, when market react from market always come down, react from the fair value gap and goes up and then take out the high, comes back. If you always react from the other block and goes up, is another form of the process. So I hope this diagram explains it. So let's go now so that I will show you how it works. So this is GBPJPY. Sorry about how I talk. I just totally lost in when I'm talking. So bear with me. So based on what I said, this diagram here, this movement here explains the engineered liquidity. Get? Now, for instance, this was the leg up here, market came down. Get? Now, obviously, this is an inducement here, because it reacted from a fair value gap here. There is another block that is yet to be mitigated. So the market went up. Get? came back. If you zoom into this, you will see that the market, if you go into lower time frame, you see that the market reacted from a favorable gap here. It went up, it didn't take out this high. It came back. The other block here, the market is created from the other block and boom, take out this high. Now I want you to look at something. Observe. Now this movement here, look at this high. Now understand that these things always happen on internal range. You get that is where you always get this type of movement. Though it's equally happens at a higher time frame, though, but mostly it happens in the lower time frame. You get. Now let's go to the chart itself. I want to show you something. Let me show you about the inducement. As I said earlier, now this is what I used to catch this trade. So this was a other block. Okay, it took off, take out this high, came back. This is an indicator block. This is an AVG where this market reacted from. This one came up, reacted from the AVG, went up, take out this high. Get. Now this other block here have not been taken out. So these two places are my inducement, aka liquidity. So I mark these two places as my inducement, being that this high is yet to be taken out. So now most people would do their take profits. Most people would do their TP1 here, but I'm targeting this high. I will explain why. Now, if you remember what I said when I do this diagram, that if market reacts from here, market starts here, come up here, comes down here, goes up here, comes down here like this, take out this high. Basically, this movement that occurs here, this inducement that happened here, it always reacts from another FUG up here if there is another block that is yet to be mitigated and they have not taken out the external high. Get it will always react from the FUG, come down to mitigate the other block, then target the external high. That's how FUG works. Sorry, that's how inducement works in a trend, in a chart, or in any pair, most pairs. So this is the leg. There's an FVG here where the market reacted from, went up. If you check out the opposite side, there will be an FVG here as this is. So this is an FVG that the market reacted from, went up, came back. This is an FVG, opposite FVG, the market came, reacted from, came back. So sorry about that. So this is basically how I'm able to identify this pair, get this stuff. So being that this FVG mitigated and it's pushed down this market down here, I mitigate this my other block here. So it's gonna take out this place. Now I will expect this other block there to be mitigated equally, but I'm targeting this high. Even if the market reacts there, comes back, it will equally take out here. So most people at their point will be to target this high here. If you're targeting this high, there is no issue, it's still good. But being that I am actually trading, I'm actually trying to I'm actually targeting the the high of this high to continue the uptrend. That is why my take profit is here. Now I want to bring something into that which will equally help you to understand properly on how to mark out your entries. There is what is called range. So how to identify a range? I basically use my gang bones to do it so that I will know where the market is going from and where to buy from. I basically buy from premium I basically sell from premium and buy from discount. You understand? So that's how it basically works. Now, how to do it is that when you look at the leg that engineer the break of choice to the opposite side, you mark from the low to the high. That is the first thing you do. If you mark from the low to the high, you get. Now if you look at this upper part here is the premium, the lower side here is the discount. You understand? So now when I look at this chart, these inducements that occurred here occurred in the premium level, and my other block is at my discount level. So I know that the market will come down to my discount level and I'll buy from my discount level to target my premium level. Now since these have occurred, I'm sure that if I enter the market here, it will definitely take out now. Why I didn't choose this area as my point of interest is, number one, this is not an inducement. If the market is meant to come to this place, this fair value have not been mitigated. And it is very far. If I want to call this an inducement, it is actually very, very far from this area. So I like my inducement to be very close to my other block. That I will identify it. I say, okay, fine, that is a proper area. Now for this market to come down to this area to mitigate here, this fair value gap here needs to be mitigated. The market needs to mitigate here. Then I will look for the other block below the fair value gap to target as my entry. So that is how I identify my trades, and that is how I'm able to catch this trade that is going up. So we are targeting this high. So I hope these explanations will help you on how to mark out a possible good trade and enter. You're welcome.